Hello and welcome to That's What You Think, the podcast by global communications agency Cognito, where we invite guests who are experts in their fields of financial services, technology and sustainability. My guest today, Michelle Cameron, who's commercial executive of Morningstar Sustainalytics, kind of sits at the intersection at all three, but she is, you have no doubt, she is an expert in sustainable investment, and that's what we're here to talk about today. I welcome you to the show, Michelle. Thank you so much for joining me.
Thank you. Nice to be here.
Yeah, no, this is a real pleasure. And I want to start by underscoring maybe what it looks like from the outside looking in on 2025, because it seems to be an extraordinary year. I've been sort of involved in sustainable investing over the years, and it seemed to have been something that maybe with a bit of a blip from the GFC gathered momentum fairly continuously and pretty consistently. This year, it seems like it's been dealt a massive blow, and there's a heck of a lot of media opposition. There's a lot of very unusual behavior from a lot of very rich people doing backflips on things which, seem to be suitable for them at the time, and this huge amount of divergence between different countries' approach and their political environments. Can you please make some sense out of this and hopefully give me a little bit of light at the end of the tunnel in terms of regathering the momentum for this movement globally?
Certainly. So you are entirely accurate. It has been quite a volatile period. It feels like we've had quite a convergence of a number of factors that have really impacted the market. And I haven't had a conversation this year, I don't think, where we're not talking about political headwinds and ESG backlash. So it feels like, post-COVID especially, we've had all of this kind of political instability. We've had a lot of kind of economic uncertainty. We've seen a huge increase in the number of even kind of climate impacting events, which have really hit the markets. But despite the noise, it really does feel like the market as a whole is maturing. So it's almost like we had quite the increase in appetite over kind of 2018, 2019, 2020 even. And then we've seen this quite significant impact over the last 12, 18 months, which has certainly impacted the progress. But so even amongst all of the noise, we are still seeing although much more muted, but still some progress. So there is optimism. But if we actually take it back to the data, and in Morningstar Sustainalytics, we manage data, we look at fund flows very, very closely, and we've seen over the last 12 months or so that there has been a lot of volatility. We've just released the latest fund flows data for Q3 this year, which has shown that there's been an outflows in sustainability funds of over 55 billion, which is obviously significant. But if you actually break into the numbers, that's actually influenced by just a couple of funds out of the UK where they've actually been redeemed, and they're moving into more custom ESG mandates. So the money is still, the capital is still in the right area in the market. So if you exclude those funds, then we have seen around 7 billion still in outflows. Most of that is from the European markets, where we've seen quite a lot of volatility. So we've had inflows and outflows this year. US has had 12 consecutive quarters of outflows, which is very in keeping with how things have been tracking over there and the kind of political uncertainty there. But closer to home in APAC, we've seen modest inflows still. So we are maintaining that momentum. Australia, New Zealand, we had just over or just under 300 million in inflows. So we are still seeing some momentum here, but it is significantly more muted than it has been in previous times.
Okay. And how delineated does sustainable investing remain versus just investment and asset management itself? Because I guess, I'd like to think most sane-minded people think that it's quite virtuous to do these kind of things properly, whether it's climate change and environmental impacts, or just good corporate governance, and the sort of traditions of ESG. So you would assume that it permeates the corporate world relatively broadly. But when you talk about sustainable inflows, give me a little bit of context about how that's measured and how a sustainable fund is marked versus perhaps other companies that have good governments, good environmental policies, but don't sit in those buckets?
Yeah, so it's a very pertinent question because it's something that we're hearing all the time at the moment, that the way that funds are measured and labelled is being impacted by a lot of the regulatory landscape. So we're even more cautious now around kind of labelling funds as being kind of ESG sustainable funds, and they have to go through a quite intensive intentionality assessment. So whilst we're seeing these kind of, like I say, more muted flows, a lot of it is actually that the strategies that underlie the funds haven't changed, but the labels or the buckets that they reside in have changed. So actually when I'm talking about the markets maturing, what we're seeing is that the strategies and the capital flow is still going to the right places.
Yep.
It's just not being used for marketing in the same way as perhaps previously it would have been. So we're seeing lesser volume of new sustainable funds being launched, which I think is also a sign of a market that is maturing. But it means that those that are labelled as being sustainability funds are able to very clearly evidence that they are doing exactly what they say on the tin.
Right. Okay, that opens up a bit of a can of worms for me, because I think about how asset managers, maybe, there are some great people, some not so great people. There are some incredibly ambitious people. It seems to be ubiquitous that in asset management, whether you like it or not, it's kind of distribution led. You've got to create products where there is demand for those products. And if it is no longer trendy and in demand to label a fund as being sustainable, then surely that lure and momentum dies off a little. So a fund manager is more inclined now to opt out of labeling their funds as sustainable because there's simply not as much investor demand for that label anymore,
or the effort required, or
right.
the regulation around it. So if you're going to label your fund as Article 8, Article 9, then there needs to be some really kind of core connectivity into that and some real data-driven intentionality. Which is absolutely the right approach. But I do think there's a lot of funds that have got it. Have got ESG sustainability themes and trends within them that perhaps are not being kind of dedicated as such. So I do think there is still a lot of really positive momentum, and I think we'll see a bit more of a right sizing of this as we get more comfortable with some of those kind of labeling and relabeling, because a lot of the conversation is still very much in flight. So over the course of the next 12-18 months, then I think we'll get more clarity on really what is being classified as sustainable and not.
Okay. You talked about a fairly anomalous example from the UK where there was a outflow from a pool fund into a mandate. That aside, there are obviously disparities between countries and blocks with regard to their approach to sustainable investing. It's no secret that the US has become a very tricky place, not just in terms of government frameworks, which are incredibly important in getting businesses to reach net zero, and we'll talk about that later, but also whether it's marketable, palatable. That a significant portion of the country looks down upon perhaps labeling yourself as a sustainable asset manager in the US. Very difficult market. Europe's always been, from my perspective, I might be wrong, a leader on these things. As a bloc, it tends to take climate change very seriously. The Scandis have always been great investors and perhaps ahead of their time in terms of making sure asset managers that they select have great sustainability guidelines. In Australia, perhaps a whole other kettle of fish. Can you just characterize maybe those three sort of blocks, and possibly any anecdotes from sort of Asia as well, in terms of that divergence in approach between them? So you're absolutely right in your assessment. So Europe has always been the kind of the
pace setter from a regulatory perspective. So they've had CSRD, EU taxonomy. It's really been the leader globally. And we're obviously seeing with the omnibus changes at the moment, or recommendations, that's going through a period of flex, which I think is probably influencing the outflows that we've seen. So Europe, but still is kind of by far and above the rest of the global regions. Like you've mentioned, US has taken a massive back step, fragmented, politicized, very uncertain. But with my optimistic frame, I do think that has potentially created opportunities for other regions where that capital allocation for responsible investment in the US perhaps may be coming to other jurisdictions. So that may be positively influencing flows in other regions. APAC, I've worked in the markets for many years now and have been very close to the region in terms of the appetite and the progress. So we're seeing a lot of the southeastern countries across APAC really now stepping up. So some of the innovation that's coming from these countries is amazing. We're seeing kind of South Korea, Thailand, Singapore, all really their regulatory frameworks are taking shape, but also the innovation from the companies, from the kind of decarbonisation angle, are really, really taking shape now. So they're really adopting the opportunity that lays ahead of them. And whilst it's been historically quite fragmented across APAC, we're starting to see that is actually, they're leaning into that and they're creating their own frameworks. And we're seeing some global consistency, especially around climate and reporting, which is encouraging. Australia and New Zealand. So if we'd have had this conversation 2 weeks ago, I would have been very positive around the New Zealand progress that's been made. They were the first to mandate climate reporting. They were really stepping ahead. We've just recently heard that on the back of a recent consultation, it's taken a bit of a back step. So the thresholds for New Zealand entities reporting has now changed, which means that the volume of reporting entities has essentially halved. So that's a real concern, and it's a really kind of it's really concerned the responsible investment community because they have been so far ahead. But here in Australia, we're seeing some great progress with the ASRS 2 coming in. There's obviously a lot of talk around the regulation requirements and entities grappling with what it means for them and how they're going to report. I'm very mindful that when you have to report from a regulatory perspective and it's seen as a burden, you're not connecting it to the purpose of the regulation. I think we'll get onto this a little bit later, but we need to be, as a responsible investment community, continuing to challenge the purpose of the reporting to make sure that it is really delivering on what the intention is. So if you're reporting and you're building out teams just to tick a box, then that is not necessarily the intention. And I think we need to constantly challenge ourselves as a community to make sure that we're approaching the mandate with the right intent.
And then just lastly, before we move on, I think in this industry, you can either be a pragmatist or you can go nuts being frustrated about not being able to change the world in a way that you would like to. Australia seems to have done a pretty good job of culturally accepting these problems and challenges that need to be overcome. Obviously, there's plenty of political friction and even friction within the LNP itself, obviously, at the moment. So those things aside, we have net zero targets and companies have taken the issue very seriously. We'll get into that later about backing the government's commitments to net zero, because without participation of companies, the government's nowhere. Any ideas as to why culturally this is sort of working in Australia?
So we've got a bit of stability at this point in time, and we've had that, arguably only really this year, where we're seeing that everyone feels like they're heading in the same direction, which is very encouraging. The responsible investment community in Australia and in New Zealand has always been very well connected. We've got some great collaborations and groups across the industry, which are helping to ensure that everyone's working towards the same goals and working very cohesively. So I think we've got quite a unique market here in the RI space. And you've got networks like, IGCC and RIA and others that are really helping to bring the whole community together and help them understand and collaborate on challenges and work through them. So I do think we're quite unique in that respect in Australia. But to your point, yes, we've got a bit of political stability at this point in time. The net zero targets are set. Everyone is working well towards them. We've got other frameworks in place, outside of just climate targets that are really helping the market all drive in the same direction. So I just think right at this moment, and as we've seen in other jurisdictions, it can very quickly change. So hopefully we've done all of the groundwork to ensure that we continue on the same path and that we see successful outcomes. And it's going to continue to evolve. Markets evolve, things change. But I do feel like within our borders, we've got some good consistency.
Yeah. I think, political stability is the key. If you think back to the times of, leadership challenges and double disillusions and things, that they were times where populist policy was probably the most influential.
Yeah.
Now we seem to be in this little purple patch of political stability, which is nice. But like you say, and it scares me when you say it, anything can happen and change can come quickly, right?
It can. But I also think it's now that we need to make sure that we are doubling down on what we're trying to achieve so that if we do go through periods of flux, we can we can weather those storms, and that we, as a financial markets working towards these goals, can continue to focus on those regardless of the noise.
Yeah, and I guess it helps. Well, I say helps, but we're a country of extremes, of deserts and eroding coastlines and severe weather patterns and perils and insurance markets that have to keep up with all those things. So perhaps that is, a pattern when you think about Southeast Asian countries that support this as well. Really, when these climate change realities hit those countries, perhaps people get a little more real about the prospects of needing change.
Yeah, absolutely. And we do see that financial institutes, so insurers, banks, they're all very closely collaborating to understand those risks and to think through how, we can accommodate them within the structures that we operate.
Yeah. We'll talk a little bit about flows from different investment cohorts, because I know you've done some good survey work recently. And I'm curious about the changing behavior of retail, wholesale, and institutional investors, because you've got, these themes aren't new to institutional investors. Wholesale investors perhaps don't have the resources and balance sheets to maybe take the same approach as institutions. And then retail, and correct me if I'm wrong, but I used to see surveys about particularly younger investors in the retail space who would happily sacrifice returns to an extent to make the right ethical decision on an investment. I feel like maybe that's changed a little, but I'm not sure. But can you give me a bit of a top-down overview of how these different investment types are navigating sustainable investments? Yeah,
so you're absolutely right. But I think when you were looking at those retail investors, especially younger cohorts, I think they've aged a little bit now.
Yeah, okay.
But you're right that retail investors absolutely have historically been very values-driven, and they've been kind of very ethical in their approach to investing and very intentional around their investment choices. I think now we're seeing that they're perhaps a little bit more cost sensitive. We're seeing that that kind of group, that cohort, is perhaps favouring lower cost passive rather than being a bit more actively involved in their investment strategies. So it feels like they are that retail group tends to move faster than perhaps some of those other segments you mentioned, but they also still move with sentiment, but perhaps are moving a bit more as a group, as a cohort. But also we've seen that they will very quickly pause when there's turmoil. So the political backlash this year, we have seen quite a shift in some of those retail investment or the evolution of the retail investor space. Support for ESG within those younger cohorts has also changed from some reports that have been collated recently. Support for ESG among under 35s dropped from 44% to 11% in 2 years, which I think was interesting. But I don't think it's due to lost interest, but to maybe a bit more skepticism of some of those vague kind of terms and labeling. So I think it all kind of goes in this kind of pot of uncertainty, and that's where some of that has stemmed from. So I think some of those younger cohorts, they certainly still are focused on impact, authenticity, but we are seeing that this kind of convergence of ESG moving from values driven to being a bit more value driven. So having to be a bit more cost conscious is certainly something that has impacted that retail group. For the other groups you mentioned, I think wealthy are absolutely right. For institutional investors, we still see very much kind of long-term trending with them, especially when we're looking at the asset owner space and the asset managers as well. We're seeing that they're still completely connected to their member requirements. So the top focus area for institutional investors and large asset owners continues to be ESG being a fiduciary duty. So we've seen that 61% of asset owners that we surveyed in our recent Voice the Asset Owner survey said that ESG was still one of the top fiduciary duty motivators, along with stakeholder pressure and ethics as well.
Okay.
So yeah, that member pressure, fiduciary duty and responsibility continues to rise. And we're seeing quite a shift from the bigger institutional investors from what traditionally they would do as just exclusion. We're now seeing much more engagement, which is, I think, again, a positive sign of their connectivity to the market and driving real world outcomes.
Now, I don't want to make the mistake of saying you have to be a good person to invest in these things and you do it despite returns.
Yeah. So
I'd love to hear a little more about the evolution of returns within responsible investing. And particularly because I guess there are, and we'll talk about this later, there's litigation risk, there are physical climate risks, there's the cost of insurance, there are, I would imagine, contingent liabilities around the wind down of certain, infrastructure investments. These are all, yes, they might be reasonable things for boardrooms to discuss in an ESG context, but they're real financial drivers. So if we scrap the do-gooder conversation and just say, right, whether you're a retail or wholesale investor, you're going to be thinking, what's in it for me? There's a cost of living crisis. I'm trying to do well. I want to get ahead. Do investors have to sacrifice returns in order to be good, sustainable investors?
It's a very boring answer, but no.
Good.
No, not at all. So we are seeing that ESG investments continue to outperform traditional investments. So it continues, the trend is still positive. So the returns are still very positive. I think, again, in line with everything else, it has come off slightly. So, it isn't quite as polarized as it was previously. But we are certainly continuing to see that returns don't have to be compromised. So again, it comes back to it's becoming more mainstream, it's more embedded, it's expected. So it's a maturing market. So when we talk about pension funds and they look at all of those factors that you mentioned, they look at the physical climate risks, they look at climate transition risks. They are natural long-term investors, and the ESG and sustainability approach completely aligns with their kind of horizon investment strategies. So no, I think that absolutely you don't have to compromise returns at all, and we're seeing that evidenced over and over again.
Great. And I want to talk about the big end of town because, and I want to talk about private equity in particular, but possibly within listed investments as well. And the lure of coming to Australia to invest in sustainable infrastructure. We're a very large country with a lot of sunshine, a lot of wind, a lot of political backing to do the right thing on climate, a lot of climate risks and threats. So naturally, we want to be a good actor and help combat those things. And there are great financial incentives, I guess, to export some of this technology to build expertise in the country, while perhaps some other countries are really going to have a brain drain on sustainable investment infrastructure and the science behind it. So is there a quieter story of capital flowing into Australia seeking out these physical and technology sustainable investments that perhaps we don't read about all the time because they might be coming from jurisdictions where it's unpopular to talk about these things?
Like the US? Yeah.
Like
so
the US.
Absolutely. So I don't know if they're quieter stories, but we're certainly hearing a lot around kind of capital flows coming into the Australian market because there is that perceived stability or stability at the moment. So we do expect that trend will continue if the current kind of global uncertainty is maintained. So it is seen, I think, as a bit of a safe haven for capital because we've got the regulatory guardrails that are now in place. A lot of the entities that are having to transition are having to do that in a very intentional and focused way, and we're seeing a lot of good progress, especially in those hard-to-abate sectors. So I do think there is a lot of appetite for investment in our local market in line with that. So certainly that there are innovations that have been developing in the US over the last decade longer that all of a sudden have lost all of their investors. So they're now looking for homes for those innovations. I mean, here is a great opportunity for them to settle. So I think that there is some real opportunity, and unfortunately it's on the back of other jurisdictions not being able to continue to stay the course.
Yep.
But absolutely, the innovation in Australia, and to your point, the landscape that we operate in, the climate that we're in, the opportunity with the likes of solar, some of the energy transition work that's in flight certainly is generating interest in local investment.
Great. Well, I hope all those involved make hay while the sun shines. And let's talk about the operating environment for companies in Australia who need to get behind these net zero commitments. So we've got a framework where the government sets net zero targets, 2030, 2050, but you need everyone to get in behind them to actually get there. The levers that the government have really are, legislative and regulatory, all this sort of stuff. It's the companies that need to plan for the next 10, 20, 30, 40 years to help us reach these targets. And I'd like to talk a little bit about the difference between the targets that the government sets, the targets the companies set, and the real progress that we're seeing. Is everyone falling in line? Are there some good and bad actors? The media's been quite harsh on those that are reporting. Can you just sort of characterize this landscape for me?
Yeah, and I think this comes back to trying to think about what we're trying to achieve here. So what are the real world outcomes? So in Australia, we've set quite strict targets, and we've just seen an enhancement to those targets, so a 2035 target of between 62 and 70%. And so we've got the expectations that are fairly well laid out. I think from an investment perspective in the investor community, there was a lot of effort to publicise targets when it was originally announced. So we saw this quite kind of deluge of companies stating targets, but actually having nothing under the hood in terms of how they were going to get there. So I think we've got a target at the moment of 46% to reduce emissions by 46%. I heard at a recent conference that we were on track at the moment 2%, and we've got 5 years to get to that 46%. That's not to say that we're not able to with all the innovation that is in flight at the moment, but it shows the scale of the challenge that we've got ahead of us. And then with that additional target of between 62 and 70% beyond that 2030 target, that's where we're going to really start seeing kind of the rubber hit the road. So it'll be very interesting over the next few years to see how that gap shrinks. From an investor perspective, we're now starting to see the community looking for positive indications that companies are on the right path. So we have ambition targets, and we've got performance targets within our suite of metrics. So as an investor, you can look at a company, you can say, we can see that they have committed to net zero by 2050. what are they actually investing in to give us confidence that they're on the right path? And what does that mean in terms of the trajectory? So we can now map out, based on the management intent and the capital expenditure, whether companies are actually on the right path. And you'll see quite a disconnect often between companies who originally stated targets and then their the performance against that ambition being massively polarized. So as an investor, when you're looking at companies, it's almost better to look at those companies who've got maybe more muted targets, but are better or more equipped and much better prepared for that pathway. So yeah, I think we're now starting to see, after the original excitement of let's set targets, let's build teams, actually the reality of getting to where we need to get to is significant. And those companies that have started early, that have got the right management in place, are investing in the right technologies. That's where I think we're going to see the biggest progress.
And aside from perhaps capital flows from investors interested in these companies meeting their targets, and maybe the risks around not doing them for their own businesses financially, what regulatory risks do they expose themselves to by perhaps being laggards without great excuses? If you're not seeing the materiality and you're not seeing the means to produce the materiality before we get to those deadlines, and the company says, "Oh yeah, okay, well we didn't really get there." What punishment is in place during that period?
So during the period, that's where I think it's an interesting kind of middle land, because until we actually get to the stated date, there's not really a lot other than kind of investor focus. And we're seeing this in, AGMs all the time at the moment, where, companies are being held to account for things that they've stated and they're not achieving, or not on the right path to achieving. So I think from a governance perspective, we're seeing the impact at the moment, but the actual impact will likely be beyond, where they've stated targets and they haven't met them. So from a regulatory and a kind of impact immediately, I think it's going to be quite minimal. We are seeing, obviously, that regulators are standing up and are litigating where there have been claims made that are incorrect. That tends to be more around things like labelling and kind of where they're claiming things that are just not happening. But I think when you're talking about the decarbonisation journey, it's a bit more difficult to quantify from a regulatory perspective, because until you get to the stated target dates, then there could be a lot of claims that are happening that are just not on the ground, and you're not going to, from a regulator perspective, you're not going to have the guardrails necessarily between now and then to manage that. So I do think that shareholder pressure is where we're seeing the most impact for those companies, and this is where we're seeing that engagement and stewardship into those companies that are having to decarbonise in a faster way than other parts of the markets. That's where I think we're going to see the biggest influence. So that's where I think a lot of the big investors, institutional investors, where they've got big stewardship teams and engagement activities, that's where they're going to be adding the value between now and those dates. And obviously, if you're not seeing the progress being made, then you'll vote against, and you'll vote with your feet.
I guess it reinforces the need for the demand for these types of investments, because if you think about it, the regulatory stick is big and blunt and probably hurts shareholders more than it does the individuals sitting in those boardrooms making the commitments, which I always feel is a little disappointing when I see ASIC or a regulator come out and beat their chest about a big fine they've just levied. I think, well, who did that hit? It hit the shareholders. Did the individual directors making those decisions get commensurate punishment? Perhaps not. So that's the stick. The carrot, hopefully, is if we make good on these commitments, we're going to get investor inflows, better access to capital, perhaps better access to green finance. It'd be interesting to get your take on that, whether that's an incentive or not? Is it real?
Yeah.
Are there big discounts available for those doing the right thing? Like, you need the incentives to be just as alluring as the punishment is terrifying.
Yeah, absolutely. And this is where I think there's been a real challenge historically with investors who have decided to, and for all the right reasons, screen companies out of their portfolios because they're operating or they've got business involvement in areas that doesn't align with their, investor strategies. But there's this ongoing debate around engagement or screening. And I think if you've got a seat at the table, you're part of that conversation, you're engaged in a conversation around how a company who's in a hard-to-abate sector is going to transition and how you can see and support that transition, then ultimately, from a long-term perspective, obviously we'll get much better outcomes.
Yep. Let's talk about the hard-to-abate sector because no two companies are the same. We have huge resource industries in Australia that have massive infrastructure investments that take place over 10 and 20 years. Equally, we've got technology companies that perhaps can deploy things quite quickly. And then we have a lot of criticism about some of the levers these companies have to pull on, one of those being carbon offsets. As somebody who works with the media, I know how difficult it is to get journalists excited about writing about carbon offsets. And certainly when there is one bad example globally, anywhere, it is pounced upon by, a whole raft of different sort of publisher mastheads and things. What's the treatment of these instruments, which are, from my perspective, a very important transition instrument for these hard-to-abate industries, and a very important price signal, and should be a healthier market than what it is in terms of price. But why is this so tricky for the media to get behind, focusing on bad actors and bad examples, which there have been some in some of the unregulated markets? Tell me a little bit about your view about, if I'm a hard-to-abate business, I need some instruments to help myself out while I can get to these targets in 10, 20, 30 years' time, but perhaps offsetting my carbon emissions right now seems to be a very unpopular thing to do.
Yeah, and unfortunately it has been for a while now. Offsets are quite a polarizing topic, and from a pure perspective of looking at this through the lens of what is the right thing to do. Obviously, we don't want to print tickets to get out of jail, and that's where the media seems to have kind of taken this view that the bad actors that you've mentioned have been the headlines, but what they've neglected is actually all of the amazing projects that are in flight because of this capital flow into areas that wouldn't have had it otherwise. So I am of the opinion that offsets do have a place. I think they shouldn't be used instead of, but as well as. I think potentially, capping the percentage of offsets as part of a transition plan is a sensible lever. But for those hard-to-abate sectors where they have got unavoidable emissions and you are able to then utilize capital in projects that are supporting nature positive, that are really like some of the reforestation, regenerative agriculture projects that are underway are amazing. I think one of the most recent changes that I've enjoyed is the reframing of the voluntary carbon markets to the verified carbon markets, and I think that's important because there are a lot of standard setters and agencies within that space that are working really hard to make sure that the projects are credible and that they are doing the right thing, and that the project developers, that everyone involved in those activities are benefiting. So the few ones that have ended up on the headlines are unfortunately the ones that have taken up most of the space. Really, I'd love to see that shift, and we focus on those projects that really are supporting communities, that are developing real world outcomes. So I am of a view that they do have a place, and I think for aviation, for oil and gas, for those companies that are able to channel that capital into areas for the short term. It'll be very interesting to look back in 10, 20 years time and see how that market's evolved. And unfortunately, it hasn't been priced, I think, appropriately over recent years. It would be really nice to see that market become a bit more live.
And hopefully observers understand that those good project developers want the price to be higher.
Absolutely.
They don't want to see a ton of carbon sold for $10.
Exactly.
It's in their interest to verify, have better integrity markers, educate the market about what they're doing. But one question I have for you is that, you talked about some of the social projects and things, and you got all these sustainable development goals that sit peripheral to a lot of the projects that are undertaken for carbon offsets. But then you've got this sort of binary issue of government setting net zero emissions targets. Okay, that's an investable market.
Yeah. What
about biodiversity and desalination of the oceans and soil quality and all that sort of stuff? Are you seeing any change whereby they could become investable markets and markers of progress on climate change and all the other sort of ESG elements beyond what we're seeing now? Because right now it just feels as though, okay, you set a net zero target, that's about emissions, that's about carbon, race to get to that thing. All these other things are nice to have and they feel good, but for an investor, it doesn't seem to be a market where you can get a reward for supporting some of those SDGs.
So I think within the VCM, there are direct connectivities into the SDGs for most of the projects. So I think when you're looking at price discovery for some of those, for all of those projects, there is direct alignment to the SDGs. So it is possible. And I think that's where it's an evolving market, because it's not quite as clean cut as, emissions, where it's one number. I think, when you then broaden that topic into compliance markets. So if you're looking at ACCUs and other markets where you've got levers that are perhaps a bit more established and well understood, and you've got the safeguard mechanism. So all of these kind of levers that are supporting that particular area in the market, it becomes a bit easier to articulate. So I do agree that in that VCM space, connecting to those outcomes, and the SDGs is a great example where the outcomes for biodiversity can be connected into the appropriate SDG. So I think there is that connectivity there, but it's understanding that from a market participant perspective, which is challenging. So I think that's going to continue to evolve, hopefully, if those markets continue to evolve.
Yeah, and maybe lastly on the offset subject, we talked a little bit before about CORSIA, and the reason why I find it interesting is because it seems to be a transition framework between VCMs, voluntary carbon markets or verified carbon markets, into compliance markets. So you've got elements of government regulation. If a country adopts the CORSIA framework, it should be enforced by the governments and imposed on chiefly the airline industry for this particular label. Are there other examples of this this merge between voluntary and compliance markets? Because it would be lovely if these things were regulated to a point where the public has more acceptance that it's legislated on how you produce evidence for a ton of carbon, for example.
And I think that CORSIA is a great example and probably the most progressed in that space. And it's an area, aviation, I think, is an area where we are seeing, to the earlier point around, we're seeing that capital investment into technologies, and you're getting the reward for those investments and that intent. So I do see that the kind of coming together of the compliance and the verified markets will continue to evolve. Globally, there's lots of different kind of similar compliance frameworks and regulators across compliance and VCMs, and I think that will just continue to evolve and get closer as there's more understanding, more comparability, and more kind of ways to create financial instruments that are directly connected to the outcomes. So yeah, I think that will continue to evolve. And I think in Australia, we've got quite a mature market with the safeguard mechanism, where there is no carbon tax. I think things like safeguard mechanism, similar programs are a good indicator that can be used and a lever. So yeah, I think that will continue to evolve. But we've got quite a well-established framework here now, and it's going to be interesting to see as we start getting more and more entities who are reporting to see how that matures.
Yeah, great. I'm going to ask you a few quick fire questions as we wrap up. I want to know your view on, and again, this is about the momentum, the global trend for not just sustainable investing, but particularly climate change, COP attendance trends and countries that are getting involved, Climate Week in New York, all of these sort of movements.
Yeah.
Are you seeing that reflect the change in US politics and popular policy, or is the momentum that was there continuing to sort of pour into these movements?
So the momentum, I think, continues. I think that the disposable income to continue to flow into some of these events is perhaps getting challenged a little bit more. But I do see that momentum continues, and the appetite for hosting COP continues to be a focus.
Got it.
And it would be great to come here.
Got it.
Yeah.
Weapons and defense. How much does this come up on your radar for investors? Because there are a lot of blurry lines about what supports things that are potentially being used in, illegal ways, maybe components used for weapons of mass destruction versus legitimate, if you can call it legitimate defense spending. That sounds ridiculous to say, but you know what I mean. How much does this come up on investors' radar, I guess, relative to things like climate change?
More and more now.
Yep.
So previously, defense, controversial weapons was just screened out from an investor perspective. We're now seeing a growing trend towards defense investment appetite. So balancing kind of sustainability with security, resilience, kind of those terms keep coming up more and more. I think there's been quite a big shift in Europe, especially obviously being the proximity to some of the conflicts, where investors are looking at what appetite the community has for adjusting some of those guardrails that previously were very, very tight. So it's coming up more and more. The appetite, I think, is still very muted, but the framing of some of those investment angles is changing. So is it okay to invest in defense or those kind of companies that are on the outskirts of defense involvement?
Yeah.
So yeah, it's a hot topic at the moment, and I think it will continue whilst we have this ongoing.
Is social media and technology and AI a hot topic? The reason I ask is because these are industries that traditionally have been given the green light broadly from an ESG perspective. Why? They've got oodles of money to buy renewable energy certificates and offsets and conduct programs that are good and all that sort of stuff. The energy intensity of AI, I guess, is just increasing and increasing. You're seeing a lot of very big tech leaders buddy up to the administration in the US to get favorable treatment, perhaps at the expense of taking seriously their climate commitments. And also there's the issue of, social media and its impact on political polarization, mental health. Did these things come up with investors or not?
Social media absolutely was a topic maybe 18 months, 2 years ago, when it was kind of fairly intense at that point. AI all the time now, and it's quite it's quite a polarizing topic because there's two elements of it. So AI, from we're a data ratings provider. We utilize AI for some of our collection, our aggregation. Our clients, our investor community are using AI and really leaning into the power of AI from a process and operational perspective. As an investable asset, obviously there's challenges from a technology, the companies that own the technology and how committed they are, and some of their views that are a bit controversial in the market. But like you say, the energy demand of AI is something that is being quantified more and more now. There was a stat that said that even a small data center takes up the same energy as a city, as a standard size city. So it's, the energy consumption requirements for AI, I think, is not fully understood yet, and that's something that we're going to have to integrate within our longer term plans. So it's not going anywhere. I think there's lots of good elements where AI can be utilized, but there's a lot of considerations that need to be fully thought through that haven't yet been.
Great. Last question. Do you have any predictions or tips on sectors for next year that might do well out of sustainable and responsible investment? Anything that you're seeing, you're thinking, wow, this is really accelerating. There's a lot of strong investor interest. I'm going to see more money poured into this type of thing. What seems to be gathering a tailwind?
So interestingly, private markets, we're seeing more and more coming up, and it's an area that we're exploring because there's been a lack of data. So it's been an area that's been a bit of a black box up until now, but we're starting to see more information related to the private markets. Other than that, I think interestingly, we're seeing a lot of progress in some of those typically kind of unsustainable areas in the market. So the hard-to-abate sectors, where we're seeing a huge amount of innovation and interest. And aviation is the other one that I think we're seeing a lot of really positive momentum. We're seeing, especially within our region, in New Zealand, Air New Zealand, Qantas, they're all very engaged in the technology transformation required to support them in a sustainable way and their industry in a sustainable way going forward. So we're keeping a close eye on those.
Brilliant. Michelle Cameron, that was wonderful. Thanks so much for joining me.
Thank you so much. Lovely to be here. Thank you.